These days, you can't be an investor without considering the macroeconomy, because if the markets go to hell in a handbasket like they did in 2008, it doesn't matter how much bottoms-up analysis you do. Everyone is going to get smoked. That's one reason why Scout Investments is focusing closer on macro and going global with its outlook. Bill Greiner is Scout's president and chief investment officer. He helps oversee $20 billion and also is the lead portfolio manager for the Scout Global Equity Fund. Bill, good to have you here on the Inside Track. Let's talk about the macro environment, because there are so many pieces to it right now. The threat of a hard landing in China, Europe's sovereign debt crisis, the debt ceiling discussions here in the United States. Do you see any light at the end of the tunnel? Is this a macro environment that's going to improve or going to deteriorate?
We think the environment, Erik, in general, is going to improve over the next few years. We think, though, it's going to take some time for the world's investors really to get sorted out what they're expecting from their governments. And I think that's being answered right now through Europe and the United States. And once again, that's probably going to take some period of time to get worked through. As the financial markets focus on balance sheet issues, debt structure, government structure, those kinds of situations, currency structure, banking structure, as we work through these issues, as we have been for the last 2 or 3 years on a worldwide scale, then as those questions are answered, I think that's setting the stage for a significant move on the upside in financial asset values as we go forward. Now, we have some work to do here.
I want to interrupt you for just a moment, because how is that the case? What is it that investors are going to find out about what they can expect from their governments that leads you to the conclusion that there's upside ahead?
Well, I think many areas of the Western world have been living beyond our means, including the United States.
That sounds bad.
Well,
right? Deleveraging sounds bad. People spending less money doesn't sound like a catalyst for economic growth.
Understand that. Basically what it says is the government is going to be moving down the scale, more than likely, in importance in the economy, and consumers and investors and those types of individuals are going to be moving up the scale, which is historically has been the case in the United States.
I still don't get, though, and I just want to press you because everybody needs to understand your viewpoint, how that translates into economic growth and how the economic growth is going to fuel demand for products and how the demand for products is going to generate more sales and ultimately more profit for the companies you're investing in.
I think at the end of the day, it not only is an issue from the standpoint of the government accounting for less of the economy overall than perhaps has been the case over the last 2 or 3 years, but it's also the issue of certainty. And in our view, the last 2 or 3 years have been surrounded by a very high level of uncertainty in the United States and also a level of uncertainty within Europe.
So if the uncertainty passes, what will change? What are we going to see that's different?
Investing levels within businesses, I think, is going to rise to the upside. I think unemployment is probably going to go down. And also cap spending on a worldwide scale is probably going to start improving fairly nicely.
Okay, but there is a lively debate, and I've heard both sides. Some people say uncertainty really isn't to blame for the piles of cash accumulating on balance sheets, because CEOs and CFOs aren't going to spend their money until they see demand.
Right.
The demand isn't there, that's why the cash is piling up.
Right.
So what's the chicken and egg here? Something has to give before that demand returns. How can you be so sure that it's a certainty question?
I believe it is a certainty issue, because it's not only certainty from the business standpoint, but from the consumer standpoint. If the consumer looks at the economy going forward and they start to see job growth to some degree, and they start to feel more certain about spending money, final demand is going to come back into the play. And when that happens, I think businesses in general are probably going to start loosening up. So it really comes down to an issue of visibility going forward. What do we expect out of our government? How are we going to pay for it? And once that's settled, be it one way or the other, then I think that's going to probably clear the decks for a nice move on the upside in asset values.
Bill, a great conversation about the biggest fundamental of all when it comes to equity investing. Good to have you here on the Inside Track. Bill Greiner, the Chief Investment Officer and President of Scout Investments. He helps to oversee some $20 billion, and you heard him say he thinks we are poised for a meaningful move to the upside. It may take a few years to get there, though.